Equity markets are currently navigating a significant divide. On one side, macroeconomic indicators suggest a period of sustained pressure that usually forces valuations downward. On the other, the demand for AI infrastructure is drawing in massive concentrations of capital. Micron sits at the center of this movement, fresh off a Q3 earnings report that exceeded the most optimistic Wall Street projections. The response in pre-market trading was immediate. A surge of buying pushed the price toward the $1,200 level, a valuation driven by a mix of institutional rebalancing and significant retail momentum. Micron has now secured 16 strategic customer agreements, locking in nearly $100 billion in revenue through 2030. These contracts have effectively turned the company's production capacity into a toll booth for the physical infrastructure of the AI industry. However, the rapid move to $1,200 creates a high-risk entry point. This level often serves as a sell the news trap, where early gains are erased as quantitative funds harvest profits from retail traders following the headlines. To manage this volatility, we look to a specific institutional allocation framework designed to capture the sector's growth while maintaining a defensive posture. This strategy involves holding SK Hynix as the primary driver of market growth and Micron as the strategic geographic shield. At the same time, it requires removing Samsung entirely to avoid exposure to its specific cycle risks. Success in the current memory market depends on separating the long-term structural advantage of these companies from the temporary spikes caused by market euphoria. The scale of this demand is most visible in the expanding global footprint of high-density server environments. In Q3, Micron reported total revenue, representing a 346% increase year-over-year. Most notably, gross margin reached 84.9%. That 84.9% margin exceeds typical hardware expectations. It suggests that Micron's role in the AI stack is allowing it to capture value at a level usually reserved for high-end software providers. Beyond the $100 billion in long-term contracts, Micron has already received $22 billion in financial prepayments. Nearly $18 billion of that is held in irrevocable cash deposits, meaning cloud giants are essentially funding Micron's future factories. These margins are further protected by a physical constraint known as the wafer penalty. High bandwidth memory uses significantly more wafer area than standard components. Dedicating more production to HBM creates a supply squeeze for traditional memory, allowing prices to rise. To further secure its position, Micron recently participated in a $6.5 billion investment in Anthropic, ensuring they are integrated into the next generation of AI model architecture. By utilizing these irrevocable deposits to fund factory expansions, Micron has stabilized the capital expenditure requirements that once drove the industry's most volatile boom and bust cycles. While the business model is strengthening, the broader financial environment remains restrictive. Fed Chair Kevin Warsh has maintained a hawkish stance, keeping interest rates in the 3.5 to 3.75% range without providing clear forward guidance. This policy has kept the 10-year Treasury yield at a high 4.41 to 4.46%, a level that typically discourages investment in high-multiple technology stocks. This creates a unique situation. Normally, a stock trading at 53 times earnings would be highly vulnerable to these borrowing costs. Instead, these high rates are acting as a barrier to entry. Challenging the established players requires $50 billion in capital, and at these interest rates, new competitors are effectively priced out of the market, reinforcing the existing monopoly. However, business-level protection doesn't stop technical sell-offs. The pre-market surge hit major resistance at $1,213.56, forming a historic double top. This climb pushed the RSI past 87, indicating the stock is extremely overbought and detached from its 50-day moving average. With a price-to-sales ratio of 22, institutional algorithms are likely to trigger selling to close the price gap created during the morning rally. There is also a fundamental risk. If the return on investment for AI applications begins to slow, Micron's $40 billion factory budget for 2027 could become a heavy depreciation burden. While interest rates protect the long-term business, these technical factors suggest a significant short-term correction is likely. Evaluating the next 24 months requires testing the stock against extreme outcomes to ensure our decisions are data-driven. This matrix outlines 3 specific scenarios for Micron's valuation through 2027. The bear case targets $800 to $850, triggered by a capacity surplus, major cloud spending cuts, and Samsung flooding the market with competitive HBM4 supply. Macro-wise, a September rate hike could force the multiple down to traditional ranges. Conversely, our base case assumes current contracts are fulfilled and yield targets are met, resulting in a price target of $1,300 to $1,450. This hinges on NVIDIA's Vera Rubin platform scaling in late 2026, maintaining valuation multiples. Our bull case targets $1,650 to $1,850, driven by a massive upgrade cycle in consumer hardware, like AI-enabled smartphones and PCs. In this scenario, the total market for high-bandwidth memory expands rapidly, allowing Micron to capture 30% of the market while interest rates fall. Mapping these boundaries allows us to set entry and exit points that are independent of short-term market sentiment. We can now move from analysis to a specific plan for deployment. The overall goal is to maintain positions in SK Hynix and Micron while avoiding the specific risks associated with Samsung's current business cycle. For those currently holding the stock, the strategy is about protecting recent gains from a potential technical correction. As the price moves into the $1,180 to $1,215 range, the instruction is to trim 20 to 25% of the position to secure profits. This is a disciplined response to the double top resistance on the chart, intended to de-risk the portfolio ahead of a likely pullback. You maintain the core 75% of the position, but set a strict stop loss at $1,050. If the price falls below that 50-day moving average, you reduce your exposure further. If you are looking to enter the stock, do not buy at the $1,200 level. The risk of a 22% pullback is currently too high. Instead, follow a 3-tier entry plan. The first 30% of your capital should be deployed only after the price gap fills, targeting the $1,060 to $1,090 range. The next 40% should be reserved for a larger market correction, with an accumulation target between $930 and $1,000. The final 30% remains in cash as you monitor the SK Hynix listing on July 10th. That listing will serve as a final check on institutional demand for AI hardware before you commit your remaining reserves. This structured approach turns market volatility into a series of calculated entries for long-term growth. Every plan must have a clear point of invalidation. If the stock falls below $850, the technical case for the current trend is over, and you should exit the position. Fundamentally, if margins drop below 70% or major cloud providers officially reduce their 2027 infrastructure budgets, the underlying thesis has failed and the position must be liquidated. I'm calling Monster, and this has been the Playbook.